Wait, Adam, you're supposed to make money from businesses?
And there's this like look, some people have remarkably large exits in tech. They are few and far between. A more frequent occurrence, but I think still few and far between, are people that take life-changing amounts of secondary out of their company, which is like, I think the track that you kind of hope to be on. And my problem with both of those things is that you're like dependent on a transaction happening of some sort to actually get anything out of this. Which, look, if you're Clay, I'm sure those guys have taken off hundreds of millions of secondary over the past 6 months. That is a very, very, it's like a lightning in a bottle situation. I'm not sure if anyone disagrees with that, but like, they built for 12 years with no revenue or something, or 7 at least. And like all of a sudden now it's like the greatest thing in the world. And 99 out of 100 other examples besides the biggest AI companies that did not get to do that. Yet, and here's the thing I always come back to with bootstrapping. Like, there are a lot of tech companies that would be amazing, profitable businesses for the founders if investors just let them be. And they won't. I don't know how else to say it other than that, right? Because our esteemed guest is my dear friend Max Greenwald from Warmly. They are a competitor. They are going at it in a totally different way than RB2B. And I love a debate. I love a debate. I had an incredibly contentious one 6 months ago with Clark Barron. But hopefully this one isn't as contentious, or maybe hopefully it is. I don't know. Contentious is like really good content. So
that was good. Clark was flipping I think a pocket knife around the whole time. So Clark, if you got like a gun or something, just fucking start.
Yeah, he's just sitting in Alabama, like flipping his gun around. He might be on this webinar, by the way. He comes to these shows sometimes.
Yeah,
Clark,
we
are
need
you
to
here?
stop talking about him. We do like you, Clark. We appreciate and respect you. Folks, recordings for the show will go live on Friday. Here's the YouTube link. They also do go live if you don't care about the video. They also go live anywhere you watch podcasts, Spotify, Apple. The audio gets uploaded there as well. So for recordings, hit that. I know throughout the show, people are usually asking about it. So with that, shall we get into our debate, folks?
Let's do it.
All right.
Audience, tell us whether you want us to start the debate. Yes or no. Let's go.
And halfway through, we're going to do something different this week. Let's do a pitch slap halfway through. So folks, if you're unfamiliar with the pitch slap, what we'll do halfway through the show, we're going to call somebody up, make sure your audience, the people you are selling to, are sort of like B2B SaaS founder or sales marketing people. That's who the audience is. And then you're going to book demos with the audience. The record from a couple of weeks ago was like 38. I think it was 38 demos. That's like a SDR's full month of
yeah, Max,
right
we booked a guy 38 demos on this show.
Wow, that's amazing.
Actually, you know what? Yeah, Max would be a great candidate for the pitch slap.
Yeah, wait a minute. Why can't I do the pitch slap? Dang, that sounds amazing.
Yeah, well, wait. Warmly's going to get plenty of exposure on this. So, audience,
whoever does the pitch slap today, I'm taking a demo too.
There we go. So, audience, if you would like to pitch slap, take the next few minutes to do your hair. Don't turn off the show. Whatever it is, clean up your background, and we will call you up in about 20 or so minutes. But let's get into this debate. So, folks, here is how this will work. I have a series of questions. I'm going to prompt both of you with them. As the moderator here, I'm trying to represent the audience. Okay. So we, the audience, really want to know about the differences in, funding, strategic direction, opportunities you've identified, and really just your fundamental vision of your company here. And audience, I am going to be looking in the chat for questions too. So if you have questions you want to throw into the debate ring, drop them in here. All right. I'm going to be going through and pulling those out. So I want you guys to give me a quick background in just a second. I'll do kind of the overall. So on one side, we have our guest. He is the CEO and founder of the VC-backed powerhouse Warmly. They focus on sort of broad scale revenue orchestration. And he is the CEO, co-founder, our friend Max. Max, welcome to the show, my friend. We're happy to have you.
Thank you. I'm wondering if I should like bring in my like heavyweight belt and a couple of gloves, you know.
Dude, a belt would have been great. We should have the like unfuck my startup debate belt, and we can like kind of pass it around to. And then on the other side, we have the bootstrapped lean machine RB2B with a team of just three, zero outside funding, a focus on profitability and efficiency. Representing them, of course, is our very own co-host and founder of RB2B, Adam Robinson.
Let's
Adam,
go.
welcome to the show.
I just want to say, Adam, you could bring 1,000 AI agents to a physical fight, and my 55 team would probably kick your team.
Boom, the zinger right off the top rope. Yeah, I mean, by the way, I'm not sure if everybody realizes this in the audience. This is like one of my favorite topics in the world. The VC versus bootstrap debate. Because like I can state what I believe and it just is inflammatory to a, you know, I think it's probably a vocal minority. It's inflammatory too, but like it really just pisses people off. So I can't wait to dive into this. It's a great topic, and I love evangelizing the bootstrapping case. So yeah, let us go.
All right. So before we get into it, we do have a lot of new people here and a bunch of second time viewers as well. Let's just do a quick little background. So RB2B and Warmly really, I mean, you guys have entrepreneurial journeys prior to both of these businesses or prior to a year and a half ago. About a year and a half ago is really when the direct competition between Warmly, RB2B, and really the two of you started. So Max, if you want to can you give us like a 1 minute background on sort of the journey of Warmly, the pivots, kind of your entrepreneurial journey? Adam, I'll have you do the same, and then we'll start ripping.
Yeah, awesome. Well, I mean, super excited to be here. It's gonna be super fun. I started Warmly about 6 years ago. I left Google from big tech and realized that I kind of just hated working for the man. Started the company and pulled some co-founders away. We had a really hard time getting started. We basically pivoted 5 times in 3 years and raised a bunch of VC funding along the way because I think we had a nice smile and a good pitch, but no real product. And one of the key things was that my co-founders and I are not sales and marketing people at all. So we didn't even know what the word SDR was until like probably a year into building. But we kept trying to build sales products and failing miserably. One of the ones we built that actually did pretty well was what you see on my screen, which is a name tag for your Zoom meeting to make you look more professional. And that, did solidly, but we basically pivoted until we got to a very similar space that RB2B did, which was website de-anonymization. And so I think we launched about a year before RB2B, but same concept of we'll de-anonymize your website traffic. Then it was at the company level, and we'll give you leads in Slack. And basically, we've been, I think, diametrically opposite strategies ever since that initial launch. But kind of in a fun way, it sort of came together just a few months ago where we announced a partnership where you can now bring RB2B leads into Warmly as we start to evolve our businesses in different directions. But hopefully that's just a little bit of a helpful background. But yeah, the quick notes are like we've raised about 20 million in VC funding, seed extension, A extension. I have two other co-founders. We're 55 people and are kind of like late stage Series A, considering a Series B in about 6-7 months.
Fantastic. Adam, you want to give a little background on kind of how you got to RB2B, and then we're going to jump into VC versus bootstrap immediately.
Yeah. So I worked at Lehman. I was not in big tech. I worked at Lehman Brothers, the now defunct investment bank. I was a credit default swap trader, which was responsible for, well, that general market brought down the whole financial system in 2008. Stuck around for a little while after the crisis. I really wanted to be an entrepreneur. Like my best friends in New York started Vimeo and College Humor in the apartment that I lived in when I moved there, and I watched that whole thing happen and had this entrepreneurial dream. And then I just like quit in 2011. It took me 3 years to create a product. The first one was called Robly Email Marketing. It was an email newsletter app. I will say that I was very influenced by reading the 37 Signal guy, Jason Fried, who has agreed to come on the show, by the way. He just like got caught in the wildfire mess in Palisades and has not gotten back with a date. But their literature on bootstrapping, and then to kind of a lesser extent, Tim Ferriss's 4 Hour Work Week, like this principle of like get paid every day. Uh, it always seemed amazing to me that you could create a highly profitable business with a very lean team and live wherever you wanted, because like that was the opposite of this 10 years in finance of like putting a tie on, getting on the subway, like going, I mean, it just seemed like freedom, really. So I got infected by that. And you know, with the exception of like a 12-month period, like I really was religious about it before, and I'm still religious about it. We can get into what happened during that 12-month period, but I also made a docuseries about it that I'll drop in the chat if you're curious. And yeah, that's a little about me.
Awesome. All right. Let's get into our first topic, which is bootstrap versus VC. So we'll start with Max. Max, you've raised a bit of money. Also curious, you can like rope this into your answer, like what you initially raised for versus what you are now, because you know most investors know in the early stages you're probably going to pivot a little bit.
Yeah.
So I guess to start, when did you first raise money? Why did you raise money? Start there.
So first funding we ever took was for an accelerator program called Techstars, and then subsequently we went to another one called Y Combinator. And I think for me, you know, I just maybe back then what I didn't realize, but I see now is that the majority of the literature on the internet about what it means to build a company is written by VCs, because these guys, you know, sit around all day and write cool stuff and try to get you to start companies. And I remember in college, I even attended started a startup conference, which was all about like the importance of venture-backed companies, et cetera. So I don't even think I knew what the word bootstrap was 6 years ago. Not that I had a dollar to bootstrap with, but yeah, I went through an accelerator program, which required me to, you know, incorporate the company, give away a percent of equity. I think it was like 100K for 6% for Techstars, and then it was like 150K for 7% of YC. I can't remember. So that was back in 2020. The pandemic actually hit for us between Techstars and Y Combinator, and we had quit our jobs at Google. We thought the world was going to end with the pandemic. And so I think that we also went out to raise our seed round around that time, thinking probably nobody will back us. You know, we don't have anyone to give us money to keep it going. And keep it going is also funny because we didn't know we were building. We were just building a bunch of random stuff and hoping that it would stick. And so we ended up getting into YC. We took that as almost a backup in funding, ended up raising our seed round as well. So the net of all that was like mid 2020, we raised our seed round, which was a combination of Techstars, Y Combinator, and about like $1.5 million or $2 million from our first VCs.
Right. Now, actually, let's go to Adam first, then I have a follow-up question for you, Max. So Adam, bootstrapping, you've been doing it for a while. Why do you continue to bootstrap? Of course, you know, now you have capital a little bit as you grow companies, but what is sort of your fundamental vision of like why I don't want to take on even more capital to grow something quicker?
So by the way, the obvious question is like, where did I get the money to like actually build the first version of Robly, right? Like once you get to like a certain level of profitability, then great, bootstrap forever. And people call me out about this on LinkedIn all the time. So I made money trading. My brother was an entrepreneur and was a financial partner in the first business. So we actually were our own investors. We did it super fucking lean. I never wanted to take institutional capital, but like at the end of the day, and James, our other co-founder, worked for free for 3 years, and Tate worked for like almost nothing for like 3 years. So that was like how we did that. If you don't have that situation, there's a few other ways that a bunch of these epic bootstrap companies got started. Like MailChimp was an agency, and they built a SaaS out of agency sort of demands. ConvertKit, there's a bunch of email companies that I know because I was in the email space. ConvertKit, this guy Nathan Barry was like selling ebooks on authority to like fund this like ESP. The Klaviyo guys they only took like maybe like $1 million of any substantial meaning that they used in their business, and like broke even all the way up to like 500 million. So anyhow, I will say you need to get money from somewhere. It's so like it's very different to get on the institutional track than to like go get money from people who would give you money if you started a restaurant. If you can't get money from people that would give you money who would start a restaurant, like you're not ready yet. That's just like my advice. But my sense is like most people can. And by the way, it's like 100 times cheaper to start a company even now than it was in 2014. So like I just don't think you need that much dough. But like that's thing number one. It wasn't like this thing magically appeared out of nowhere with no money. It's just we were able to use our own and get it started cheaply enough, and people were willing to like put enough sweat equity in that we never had to use institutional money. Um, I was always, except for again this one year, which I dropped the playlist in when I got like very distracted by the unicorn dream, which I can tell the story of literally exactly why that happened. Uh, I was just always drawn to the flexibility and like growing profitability in business to me just like to me it's the reason that you're in business, right? Like I don't know.
Wait, sorry.
Tech
Wait, Adam, you're supposed to make money from businesses?
and there's this like look, some people have remarkably large exits in tech. They are few and far between. A more frequent occurrence, but I think still few and far between, are people that take life-changing amounts of secondary out of their company, which is like I think the track that you kind of hope to be on, right? And my problem with both of those things is that you're like dependent on a transaction happening of some sort to actually get anything out of this. Which, look, if you're Clay, I'm sure those guys have taken off hundreds of millions of secondary over the past 6 months. That is a very, very, it's like a lightning in a bottle situation. I'm not sure if anyone disagrees with that, but like, they built for 12 years with no revenue or something, or 7 at least. And like all of a sudden now it's like the greatest thing in the world. Um, and 99 out of 100 other examples besides the biggest AI companies that did not get to do that, right? Yet, and here's the thing I always come back to with bootstrapping, like there are a lot of tech companies that would be amazing, profitable businesses for the founders if investors just let them be,
Hmm.
and they won't. I don't know how else to say it other than that, right? Like, yeah,
Can you elaborate on
with
that? You
with
mean
the with the
strategically?
well, so like with the prices that investors invest in venture, generally speaking, in growth equity is something a little bit different, but they still need it to grow. But like they just have to make it much bigger to the point where they're willing to risk the company going to zero to do so, because that's kind of the way the math works and all this. Again, growth equity is a different deal. They need every company to win, which is, I think, slightly better for the founder. And a lot of times, when you get your company to a point where you can do a growth equity deal, you are taking a substantial amount of secondary out. Um, but still, it is kind of both of these realms are like dependent on a transaction happening, which I don't like. It's like it makes much more sense to me to just sort of keep growing profitability and like paying yourself more and more every month and every
There
year.
you go. So the venture model, right, is like a VC has a portfolio of bets. They take whatever, like 30 bets. They push each one of those bets to sort of an extreme, asking them to have kind of extreme growth rates, really take a risk on an outcome that like might work, but only if the market timing hits, or going after customers they're not ready for, et cetera, because they know that a few of them will break out and they'll make back some amount of returns. It does inconvenience or sort of fuck over, to use the unfuck my startup term, um, the 80% of those founders. And likely like a few will break out, a few will break even, and from that break even, maybe we'll make a little bit of money, and then most will go to zero. So there needs to be, I think, an understanding of founders that when they jump on the venture treadmill, what those economics look like for themselves, and the percent chance they have of a likely outcome. And I think Adam brings up a great point around, if most of these things don't work out, are you the kind of person, or do you have the kind of uh, sort of risk appetite to roll the dice for a 10% chance or 5% chance at an ultra exit, a 15% chance at an okay exit. But either way, you might be spending 7 years, where like the majority of the time you end up with kind of jack shit. And so for me, like at 20, was it 23 or 24 when I started this business? I didn't have a house, didn't have a mortgage, didn't have a spouse. Like there was sort of no downside and no risks in my life that would prevent me from taking this leap of faith. Where I, was totally fine if 5 years later I walked away with nothing and I at least learned a ton. Because, like, in a way, for me, my first startup, which is a venture-backed one, and I think an interesting one is like, what will I do for company number two, is to focus on learning at all costs and knowing that like I am learning an absolute ton every day, and I get the benefit in a way of having VC dollars to prop me up along the way while I still experiment with profitability, product market fit, like all that kind of stuff.
Dude, here's where the debate starts, and I'm so glad that you said that. So, number one, my opinion is the cost of you not doing what I did is massive. Right? And I think it's the way you looked at it as a young guy is probably exactly how I would have looked at it had I not had my life experience. And, like Wall Street shackles, bro. Like, like I remember when they gave us 2-week vacations mandatory to get away from our trading books. It felt like a year, because like the longest I'd ever taken off work is 1 day. So like I was so intoxicated by this idea of freedom that I was like way pushed over in this direction of bootstrapping. But the reason I do what I do and talk about what I talk about is because I would love for more people starting where you were starting to just know that this was an option. Like, dude, and by the way, I've been at it for 12 years, but like our business is making over $1 million a month in profit right now. Like, doesn't
Yeah.
matter what my equity stake is in that. Like, I'm doing great, right? And that's like something that if you don't go down that road, I don't know, if you're just not even aware of that road exists in the beginning, then
Well,
it's
think
just like it's just so much better, in my opinion. Like there's a much higher percentage chance that you will get to where I am now 10 years later than making a VC back company work. And the other problem with that is, uh, man, early stage is so exciting, and they sell you on the fact that you're going to be the one.
yeah.
And they're not sitting there saying like, by the way, there's a 90% chance this isn't going to work for you.
Yeah. Well, I was gonna say, think about me at age 22 in college at a conference where a Sequoia partner gets on stage and says, you can be Max Levchin, like you can be, whatever, like Joe Gebbia, founder of Airbnb, like that kind of thing. And of course, you think, or you feel deeply in your heart. I mean, you're 22 years old. You're like, hell yeah, like I am that person. I'm going to be that person. And then it's like, great, like quit and start a company. And then it's like, oh, you started a company? Who'd you raise from? It's not
Yeah.
like that's like it's almost said to you as an automatic, which is like, oh well, I have to go talk to VCs. Like VCs are the only option. And so I think you're right that very few first time early founders um, understand the full range of options available to them, especially when like YC is the one doing the majority of marketing to 23 to 25-year-olds on, hey, like you want $500,000 to start a company, like let's feed you that drug to get started.
Yeah. And by the way, like, I just want to touch on the emotional journey of the social status of the two paths.
Hmm.
I don't think so. Like Robley was like just the summary of my first business. It got stuck at 3 million ARR. We had 38 employees. We had to downsize to like 6 to figure it out. Out of that came retention.com, which is now 20. And then out of that came RB2B, which is now almost 6. So like during my Robley journey, which was 6 years before we started retention.com, uh, I didn't have investors. I had no other friends in SaaS in New York. It was incredibly lonely. When I explained the business to anyone who like knew anything about SaaS, they had this kind of like, oh, poor child thing. You know what I mean? Like,
Yeah.
I did not feel. And by the way, I was like trying to grow it. It was not working. And this was my first thing. And like the thing that got us to 3 million ARR was kind of like this data hack that we figured out. It like wasn't, I didn't consider it like a real customer acquisition mechanism. So I didn't feel validated as an entrepreneur. Summary of all that, I felt incredibly small being a bootstrapped 3 million ARR entrepreneur, despite having an okay lifestyle. It tortured me. It left me in a very uh, anxious position, knowing that I couldn't afford to have a family in New York with this business that I had. I had to pull something else out of the hat, and I had no idea whether I actually had it within me to do it or not. Right now, I feel completely different because I don't want to jinx myself, but like it's going really well, right? But at that time, that is, you know, it, if you have, it's almost like there's nothing in the world that's validating this path that you're on, right?
Mm.
And like there's a ton in the world that is validating the YC path, right? Like you can put it on your LinkedIn and people all of a sudden assume, like this guy who's been very influential in me, Dave Rogenmoser, who started Jasper. We shared an office for 2 years before he started Jasper. And that's actually the reason why I did this unicorn thing. Like the reason I hit him up in the first place is because he was like a YC founder. And I was like, oh, Dave, will you talk to me? We were both in Austin. I was like, can I come talk to you about what YC is? Right.
Yeah.
Like, so so yeah, there was a very long period of a very lonely and very insecure, for lack of a better word, state that I was in as an entrepreneur that has since passed, but it was very real. And like if I were 25, like I was a Wall Street trader, it was the opposite of that. You walk around New York and everyone respected you, right? Like
I think the interesting new things in vogue that I'm seeing the last 6 months is the seed strapping concept, where it's like you don't have any money to get started, whether it's through angels, which I see in the comment here, which I appreciate that comment, or it's like seed round VCs, where as long as, I mean, either you can not be upfront with them and say, no, no, I'm gonna rocket ship this thing, it's gonna IPO, whatever, or you can say, listen, I'm trying to, grow this thing to 10, 20 million on ARR. But basically the idea is like you take a million but I guess it doesn't have to be institutional, but a million of some funding where you're keeping vast majority control of your business, but your stated intention is essentially to get profitable as fast as possible and never raise again. And I hadn't even heard of the word seed strap until 6 months ago. But like if I had to start over tomorrow, and maybe this is where we can get into debate, Adam, I don't think I would bootstrap from day one. I think I would take $1 million to be able to hire a couple of people and get going with an intention to very quickly get to profitable and never have to raise again.
okay,
Is there a
so
world where you
I
can do
love
that
that,
now?
by the way, and I was like bringing up LinkedIn to like talk about this post that I made. Uh, Paul Graham, who started YC,
Hmm.
somebody asked him, and it was like during COVID, but it's like effectively the same now. They're like, what would you do if you were starting a startup? He said, I'd go to YC, then I would graduate YC, and I would only take $500,000. I would
Hmm.
get to product market fit. I would get to profitability and figure it out, because then you control your own destiny. I think the problem is it's just so easy. So like he and by the way, Casey, I'm going to answer this question that you asked. Did I pick bootstrapping or did it pick me? Because it's a great question. Um, but it's like either way, for Max, you to win, or for me to ultimately win, we have to get to product market fit. It's the only fucking thing that matters. No
Yeah.
marketing that you do will work without product market fit. Everything that you do will work once you have product market fit. It doesn't
Wait,
matter
sorry,
where
you're saying if I don't make more cool shirts with my logo, I'm not gonna
so
win?
so by the way, maybe I'll do a swag drop too. Maybe we should just do a swag drop to this crowd. I feel like they want the swag. So you have to do that regardless. I think it's actually more beneficial to do it with fewer resources,
Mhm.
because if you ask Diana, my co-founder of retention.com, she's like, we started with 6 and we stayed at 6 until we had 12 million ARR 3 years later. She's like,
Mhm.
I loved that because we could only do the stuff that mattered, right? Like it was just this hyper focus because like we had to. So so it's like the problem with, I think, the venture model is that once you start showing signs of early product market fit, in every environment that I've been starting companies in, everybody that I know who's had it just gets overwhelmed by investors, and they just end up raising more than they need, right? There's this like, we had Ryan Alice on. He's like, you should only raise 1 times your revenue of VC. Who do you know that's actually fucking done that? I mean, he did it in like 2012, right?
Mm.
But like, I don't know a single person since who has taken VC and only taken 1 times their ARR. But you probably agree that that would be the smart thing to do, right? Or just do revenue-based funding through Lotka or something like that, right? But no one does it because it's too exciting to raise money. And it's the social status thing again, right?
It's not social status, and this is just, I mean, from a deep place of insecurity around like wanting to be liked, like to have someone across the table from you who's like, I want to give you millions of dollars because I believe in you, like you are
Yeah.
great, just
Yeah,
feels
dude, and you
amazing.
go
It's
tell
like,
your mom, you go tell your grandma. They're
I
like,
did
what?
tell my mom,
Yeah,
and I did tell my grandma.
exactly. Grandma's like, holy shit, like you have $100 million company. It's like, yeah, grandma, what's up? Let's go party. So that is my biggest issue. It's like seed strapping, yes, but like how, and by the way, I even caved to this. How do you resist the urge once you hit early product market fit to stop the investors from banging down your door? You know what I mean? Like, how do you stop? I don't know. I'm not big enough to do that. Which one more thing, and then I'll turn it back to you. Casey, you're like, did you pick bootstrapping to bootstrapping pick you? So the time in 2022, when I wanted to do this unicorn thing, I actually wanted to do a growth equity round. And I thought our churn numbers would improve dramatically when we really honed in on big Shopify stores as an ICP for retention.com. Um, it looked like that was happening. And kind of so I started talking to a bunch of growth equity investors. They were all very interested in doing like, 50 million to 250 or whatever. But at the same time, we were overselling and our churn metrics were not improving. The market for companies like that, even who had good metrics, was like evaporating in front of everybody's eyes. And I would consider retention.com right now uninvestable by the metrics of growth equity. It's not a venture back story, and growth equity needs 90% logo retention, and we're like 40% logo retention, something like that. So like it's kind of not even close. A strategic could roll it into a portfolio at some point, but like that business at this point, it's like just figure out ways to grow profitability. And then, if the whole portfolio of things, it's like, 12, 13 million EBITDA, that's like, you don't have that many options, but if we can get it to 20 or 25, all of a sudden we can do like debt financing against half the 10 million EBITDA, and like get liquidity that way if we want. Or it's like so much, it's like, who cares? So that is the answer to that.
I have a question for Max. Before I do that, though, folks, is anybody eager to pitch slap? If not, and you want to continue this debate and not take up kind of our precious time, or not take up, not consumes the rest of the time here. Email producer at RB2B.com. We'll do the pitch slap next week and the weeks after. Or someone really wants to crush it, drop it in. We'll let you in at the end of the show. Okay, my audience, I'm talking to you there.
By
Producer
the
Pat.
way, I want to comment on our retention, since it's retention.com. We're 8 minutes past the halfway point. We've only dropped about 2.5% of the attendees, which, guess what, Max? That means you're a killer guest.
Oh,
Max,
that is such a nice
There's
thing to say.
usually a mega drop at the 30-minute, and you got them hooked, brother. What can
Yeah,
I say?
people are usually
It's
sick of
either
me
that
about it
or
at this point.
no one's trying to do work in the last month of the summer.
Right.
There we
Could
go.
very well be.
Max, my question for you. So, like, you brought up seed strapping. You've already raised a bunch of money. You have good ARR, right? You're growing. You have good, good product market fit. You now have 55 full-time employees. What is there something that is keeping you on that path? Because hypothetically, or maybe I just don't know enough about your arrangement with your investors, but hypothetically, there is a world where you could start going down that profitability route, or maybe there isn't. But like, what keeps you on that route, I guess is the question.
Yeah, so I think it's a really interesting one, especially because now, in a way, is sort of the time for me to decide. Because I think this is almost one of the last opportunities to get off the venture treadmill if I ever wanted to. In that, you look at businesses like Apollo, and we're talking the go-to-market sales tech space. Apollo, 150 million in ARR, growing, I think it's like 10 or 20% a year. It could be a little bit off on that, but like they're sort of flat-ish and struggling. You look at Six Sense, they're I think basically slowing down. I think they're like whatever the opposite of growing is. They're like going down by like 10% a year. Uh, what,
Whatever the
what
opposite of
they're
growing is.
shrinking.
It's
They're
not
shrinking.
it's not good for that company. Let me tell you,
Yeah,
let me tell you how
yeah.
much.
Adam and I can both bond over our love of Sixth Sense. But they're shrinking at like 10% year over year at 300 million in ARR, I think. And so these are like the kind of businesses that are stuck, can't really get acquired by, private equity. They could, but like they can't really go IPO. And so, they're frozen. In our space, by the way, Zoom Info, I think, is the only business to ever go IPO in the like sales and marketing tech space. Maybe there's one or two others, but the point is like to keep going requires you to think to yourself, can I reach that next milestone, either for a venture funding event or to be able to IPO or have some sort of huge potential exit. And so we're growing right now at like we'll hopefully grow at like 3x this year. And our plan is to take a Series B. But if I take a Series B, I need to have the conviction that I can get to at least 30 or 40 million in ARR if I want to stay on that venture treadmill. Because at some point, you've raised so much money that in order to sell and make back that pref stack and then make a lot of money yourself, gets tough. And so, for example, I've raised 20 million, which means I have to sell at worst for 21 million, let's just say, or 20 million and a dollar to see a dollar back myself, assuming you have like normal VC terms and stuff. And so let's say I wanted to make, I don't know, $5 million off of Warmly. And then I, take into account all my investors, my co-founders, et cetera, dilution of what I have today, the numbers start to get pretty high, which means that we need to be very thoughtful about what we're doing. And so Warmly right now is an unprofitable business. And we are at this place where I could try to push my foot on the gas on growth, and I could try to push growth way harder to try to get to even better venture metrics to get a great Series B. Or I could stay where, not where we are now, but like I could basically get more conservative and then shoot to profitability. And I think there's actually a decision point for us in January where we have to basically pick a path of like, should I stay on the venture treadmill forever or should I try to get off? And I see now, it's interesting now, 6-7 years later, that getting off is going to hurt, meaning like it's possible, it's doable, and the outcome still needs to be pretty big if I want to see a lot of money from the business if I go toward profitability.
Fair enough. I want to kind of establish the different routes that you guys have taken to get to where you are today. What I want to get into next on the second part of this discussion is like, so with those investors, or in Adam's case, with kind of a bootstrap team, your definition of success changes, right? Based on on all the math and the outcomes that you're talking about, Max. So, basically, this ID space is getting more crowded, market's evolving, people are taking different paths. I guess, Max, to start, what is the path and sort of strategic vision of beyond sort of person level identification features that you want to deliver to the market with Warmly? And then Adam, I'll ask you the same thing for RB2B. What I want to highlight for the audience here is how like these different paths and sort of like people in a directly competitive space can start to veer into different directions and then all of a sudden not be really all that much competitors anymore. So curious your direction in the next, say, couple of years for Warmly, what your goal is.
Yeah, and one thing I'm kind of curious if potentially the different paths you and I took, Adam, had to do with our sort of fundraising background of Bootstrap versus the VC-backed model, but where one encourages spending money, which means hiring employees and going more up market for bigger deal sizes, and another encourages what's the fastest way to get to profitable quickly. But like from a product perspective, Warmly is becoming a suite of products and features where if you look at our homepage and sometimes you're like, well, these guys do a lot. And then breeds confusion, and you're like, well, I guess I have to take a demo, and then you have to loop in 6 people on your team, and basically we're not really a bottoms up kind of free motion. We're a sales led motion. Thanks for the screen share there, Pete. And we have a series of things. If you like go over to our AI agents or our solutions or whatever, we have a whole bunch of stuff, and we sell deal sizes that are like 20 to 50K in size. And that means 6 or 7 meetings. It means salespeople. It means sales engineers. It means CSMs, and that requires people, etc. That's very different than Adam's motion, which is very targeted, singular feature or product that does one thing super freaking well. And people know what RB2B does. I mean, we have people get on demos with us, and they're like, "Oh, you guys are kind of like RB2B," and I'm like, "Yeah, but there's also like a lot more to it." Whereas I'm not sure on the AI demos that Adam's doing. They're asking him, "Oh, you guys are kind of like Warmly," and there's pros and cons to that. But yeah, I mean, I'm happy to dive in further. But that's sort of the high level here of like we're a suite of things going after big deals, sales led, And Adam's product, as far as I can tell, is like singular focus, singular feature, and it's just a very different approach.
Yeah. And I think one of the reasons that has drawn me towards trying to be that very clear, well, there's a couple things. One, I watched MailChimp have this meteoric rise with this freemium offer in a space that no one thought could be freemium. I think that's changed because everybody thinks everything can be freemium now, but I'm like obsessed with the power of free. So that's one thing. And then if you have a freemium product, for the most part, it's got to be a pretty simple value proposition or like and pretty simple to implement or like that's just not going to work. And then one of the things in this space in particular, which I would call, maybe I'd call it signals, maybe I'd call it orchestration, maybe. I mean, we're probably the most basic signal tool there is, I would hope. Um, the competitors who people take seriously all are funded, and there's only one direction for them to go. It's like you got to get bigger deals. That requires in how do you sell bigger deals? You sell more product, and that is complexity and that is whatever. So, um, and it just, it was kind of a, maybe not a coincidence. I don't even know how to say this, but like it aligned with my values but what I'm more interested in, by the way, is like a segment of the market that I feel like I'm going to be the only competitor in.
Mm-hmm.
It's more interesting than anything to me, but it happened to be the case that I felt like nobody was going to go after $149 implement in 5 minutes website signal that's super high churn for like a lot of reasons. You know what I mean? You just can't. I mean, I'd get laughed off YC if I said this was my business, right? Like they don't. But on the other hand, like from my perspective, and by the way, we debated this when I did that first post of like Warmly versus RB2B in the post. It's like, what would you rather be the CEO of, like a 9-figure ARR business with 1,500 employees or 15 million ARR with 3? I would rather have 15 million ARR with 3. That's just who I am. I, I
And by the
see.
way, just to be very clear, I would take the other one. Like one of the things that excites me about kind of the personal development and growth in life is like having a big company with lots of people and getting to like learn and grow from that. And the complexity probably is very high. But it's probably because maybe my North Star at the moment, at this stage in my life, isn't the most amount of cash to go live a great lifestyle. It's like the excitement of like getting to put my hands in many different things.
Yeah, and by the way, there's absolutely nothing wrong with that. Like one of my mentors here in Austin is this guy named Brett Hurt, and he's like, he just sold his business to ServiceNow, and he is a 5 times other entrepreneur. Started Bizarre Voice and IPO'd it in 6 years as a CEO. The whole journey. He's sold for hundreds of millions of dollars, several other businesses, and he's just like, if you gave me an ice cream stand, I'd be like, how do I make this ice cream stand global? He's like, I just can't not think, how do I make these businesses the biggest ever? And he's really good friends with John Mackey, who's the founder of Whole Foods, and like very ambitious in the same way, just like global domination, right? Like, and we have chats about this. He's like, I just couldn't do what you do. It's just like not like I'm just not wired that way. Like I would never. He's like, I ran Bizarre Voice break even, but like I could never go beyond that, beyond just investing everything else back in. Um, so, different strokes for different folks. I, again, one of the reasons why I'm as loud as I am is because I just feel like my perspective, people don't even know that it's possible and it's worth knowing that it is, right? And that furthermore, I personally believe that it is a lot easier to get a company to 10 million ARR with 3 people than it is to get anything to 100.
Hmm.
And if you can do that, why are we all doing this? It's like, I think a large reason everybody's doing it is to make money. Like your sort of probability adjusted financial return of that journey is astronomical compared to the YC path. you
Mhm.
know, astronomical. Like it's not even close. So yeah, excellent point to bring up.
I like too how you
People
like
are
talk.
different. People are different, right? Like,
And then like it's interesting because like then those different approaches or that North Star completely shifts how you look at a certain, combination of variables. So for you, Adam, you're like, oh, 3 people, 10 million. That's like, right in front of us. Like let's gun for that. And
yeah,
that's the greatest outcome. And we'll whatever distribute all that profit. And but then there's some people who like that just doesn't sit in their stomach. They're like, great, okay, then what after
yeah,
that?
that's
Like I don't
cute.
need the
You know,
I think we should definitely address the company size from an employee count perspective, because I think there's been this interesting shift in the last year with the rise of AI around uh, really, I'd say, once and for all, getting rid of the it's cool to have the most amount of people on your team as possible. And now I think there's been a shift toward have the right number of people who are awesome and hardworking. And, in my head, I really think about like who are the people I love working with. I mean, I have a team that I love to work with. They're all really cool. And they also all serve a really helpful and important function in my business. But with this new metric coming out around revenue per employee, which I said this recently at a marketing dinner, and somebody was like, "How about EBITDA per employee?" And I was like, "Okay, well, I'm not even close to that.
we're
Not
gonna
profitable, my
get
man.
into
Like,
that discussion.
wait for that." But I just think and maybe this has just hit me like a brick in the face in the last year around like, it's yeah, there's just a push toward getting a profit. And basically, hear a VC say to me, if you want to raise your Series B, we want to see your revenue per employee go up. Is I think a good sounding call or alarm for all founders, and that causes me to not just add another headcount, but see how we can make our current team more effective.
I love that. There was a uh
One thing I was
let's
actually
see.
going to ask you, Adam, is what hurts the most about staying at three people? Like, there's got to be some role or responsibility or something, and you can tell me if there's not, where you're like, oh my God, if we just had a human being's eyes on this for a little bit, it'd be really helpful.
Yeah, so what used to really frustrate me when we were super lean is that like I had to write all the website copy, or like it wasn't even like I kind of enjoyed like uh, when I was in the mood just like ripping apart the entire thing and doing it over again. But when
Mhm.
like a page had to get made and I was literally the only one that could do it, like and no one else could even come close to something that I liked, that was really annoying work. Um I don't really do and look, by the way, like uh, we have shared but like I'm not dealing with like payroll, you know what I mean? Like this is stuff. But then again, like the systems that help you deal with this as a small company now are really good. Like JustWorks was amazing. Like when I was doing QuickBooks and just looking at it for every Friday, it like wasn't that big of a pain in the ass. Now with retention.com, we got so much going on that we like have to have somebody handling that shit.
You're saying you have a couple agencies, a couple of great pieces of software, and that
Yeah.
takes a big.
Yeah, yeah, exactly. But like one of my favorite examples of someone doing this in the e-commerce world, we had Ryan Babenzian from Jolie, it's a showerhead company, on last year with Bruno from Clay because they both have these killer UGC motions. And I wanted to like compare and contrast D2C UGC and B2B UGC. And it was exactly the same, by the way. Like it was a great show. We can drop a link in the chat if you want to like learn about UGC. It was fantastic. This dude, and I told him when I started this, I'm like, I want to be the B2B exemplar for this. He was a super talented founder. He sold a shoe company to Steve Madden and just waited on the right product to do this with that had recurring revenue and like one size fits all and all this stuff. Uh, and they like got to like 19 million recurring revenue, 50 total within like 18 months, something insane. And they raised like $1 or $2 million for a physical product, which is bananas. They hired their fourth, so it was two co-founders and like a, executor or whatever. They hired their fourth person like a week before the show, which was like 2.5 years in, with that amount of revenue. A physical product business, they're dropping 8-figure EBITDA like to the bottom line to just them. So like
Wow.
if they can do that with a physical product, like with AI and software and all this stuff, it's like, man, like there is just such potential to create wealth in this cash flow way these days that I just
Mhm.
need to like be the, representation for and of and like all this stuff and just keep talking about it. I mean, it's great content, but like it's also, again, just like more entrepreneurs need to know that it's possible, right? Like, I mean, the fact that that guy can do it in a physical product is mind blowing. You know, it's just crazy, and he's doing it. He basically it's like core team agencies executing on all this other shit.
Mm.
Like it's kind of like this marketing machine. He deals with marketing machine. His co-founder deals with the product, and like their assistant or whoever it is, like kind of does everything.
Yeah, especially in the world of like agencies, fractional work, like it is, and especially for sales and marketing, it's like very easy to find that work and run experiments and not have to add to your head count and understand how much you're going to put in and kind of what the expectations for them are. So I think for all the reasons Adam mentioned, it's easier than ever to do that, to start a company. And also, I mean, from Max's story of his background, starting with the tag on the Zoom and really just pivoting, and now you're building a full platform. Like the place you start isn't going to be the place you end. There's no utopia. You're constantly going to be evolving here. You're really just trying to it's really just revenue exploration. Like where can I make money now to get me to the next level? And I think too, like a big thing you guys both touched on is like really defining success, not just from a money standpoint, right? What type of freedom do I want? Am I trying to escape having a boss altogether? Because sometimes investors can, I mean,
Yeah.
not sometimes, they're your boss.
Adam, there's a comment in the chat from Nate that says, "What do we actually disagree on? Where do you think we disagree most?"
Yeah, let's just get right into that. Yeah. You have an opinion?
So, I think we disagree with. I mean, it's a weird way to say, but like your ideal, like the fact that you would pick 100 million ARR company with 1,500 employees, and I would pick 15 at 3 is like a major philosophical disconnect in our approach.
Yep.
Um, that and that to me represents a bunch of downstream things, like the way decisions would be made, the way you would go about building that company, goals from the start, the types of products you have to build, right? Like everything involved in that path for you is like you're doing things the opposite of what I'm doing.
Mm-hmm.
Like I think you're currently in a moment where you're evaluating whether this company could be that or not. And if the answer is no, then you proceed in a different way to try to like, maximize the value of the company for everybody. But
Right.
like that's the biggest disagreement, in my opinion.
Yeah. And I think it's actually really interesting that uh, you guys are, but you said you're 6 million in ARR, we're just crossed five. Like we're in this interesting moment of like similar-ish external scale, but very different metrics that we focus on. And at the end of the day, like wherever you focus your time on which certain metrics will probably drive the behaviors that you implement in terms of the motions you do, et cetera. So for me, like ARR growth and net revenue retention are our two North Star metrics. And there are some downstream important ones like GRR, revenue per employee, burn multiple, stuff like that. But at the end of the day, I am willing to hire another CSM to help improve NRR. I am willing to hire another salesperson to improve ARR. Like those are my kind of like North Stars, and I see them through the lens of what do Series B investors want to see most for those metrics, and that drives a lot of our like decisions and behaviors.
Yeah. And at the end of the day, my goal for my two businesses is to just keep growing the 6-month rolling average profit number. Like if that thing's going up, I don't care what my churn is. I don't care if one product in the portfolio is going down and the other one's going up. Like if that continues to slowly grow, eventually somebody will buy this thing from me. If not, great. And like I'm still having fun doing it. Like you said before, love the team.
Yep.
I'm interested in the products that we're building. I think they can be so much better than they are, which is like just it's an exciting place to be.
Nice.
Um, well, there's still good questions rolling through. I guess let's just end here. Is there, in each of your opinions, I guess briefly, is there room for both your products in the market? Do you think one of you will inevitably win?
We're not selling to the same people at all anymore. Like I'm literally going for a $149 a month, 5-minute installation. I'm trying to make it go from a 12 months of that 149 to like 18 or 24. If I can get to 18, great.
And
And
I,
I'm really I'm focused on one workflow. It's like I want to do the website ID and outreach like better than anyone else. And we the outreach part we haven't done yet. Okay, to you, Max.
basically, as of this quarter, we try to sell RB2B with every one of our new customers. So like it is default included in our packages to get RB2B. You can take it out if you don't want to pay for it with our agency discount. But like I want this guy to continue because his website ID helps improve our overall waterfall of website ID rates. And our mid-market customers want it and like it, and our workflows allow us to connect to their Salesforce and to help them do lead scoring. Like we're doing kind of a big push on lead scoring, and then we're also this week we're launching an SDR agency, and so like we're offering human services. We have go to market strategy sessions. We have complex Salesforce CRM integration. Blah blah blah. That's the stuff that like my human team and my more complex product workflow can help for the bigger upmarket folks, where we can add that in with Adam's awesome data. Like my customers are happy.
And I'm just like not interested in doing any of that.
I love
like
it.
yeah.
Spoken like two seasoned entrepreneurs, knowing that there's space for both of you and sort of infinite things you can create, service the market with, and just being very focused and determined on that path. So I love it. Guys, audience, thank you so much for joining. Max, thank you for joining us, man. This was great. We'd love to have you back on and see how far apart RB2B and Warmly are a year from now. It's gonna be
I love that. We could benchmark it once a year and see
yeah.
where we're
Totally.
at.
Well,
Totally.
folks,
Thanks
next
for
week.
coming on, Max. This was really good, man.
Great to see you, dude.
Yeah.
Maybe see you next week.
Yeah, I'm sure we will.
And I won't be seeing you guys next week, but I will be here seeing the audience next week. I will be hosting the show with Manny Medina. We'll be here, founder of Outreach. That's going to be a great one. So back to a little bit of cold outreach, which is a beloved topic on this show. We'll see you next week. Same time. Recording goes live on YouTube on Friday. Cheat sheet goes live tomorrow on my LinkedIn. Folks, thank you so much for joining. We'll see you next week.
Thanks, Max. Thanks, audience. You guys are awesome.
Yeah.
Bye.